Imagine being caught in a market correction when the very tools you used to invest against you are the ones forcing you out.
It's the perfect illustration of how leverage doesn't just amplify gains, it amplifies the panic.
And the real question is, how do we fix the system when the risk is baked right into the instruments themselves? Welcome back, I'm Bella.
And I'm Michael. This show's scripted and produced with AI, built by Taha Baba, pulling today's stories straight from blog.tahababa.com.
If you want these landing in your feed most days, go ahead and subscribe. Let's get into it. It's a pretty stark story about how a market correction can turn into a liquidity nightmare for retail investors.
It really highlights how easily leverage can turn a simple correction into a catastrophic event, especially when people are using instruments designed for sophisticated strategies.
So the issue wasn't just the market dip, but the compounding risk from those 2x or 3x semiconductor funds and the added margin.
Exactly. It's a classic example of how leverage amplifies both the potential gains and, more dangerously, the potential losses when the market turns against you.
It makes you wonder what steps people are actually taking to ensure their portfolio leverage aligns with their actual risk tolerance.
That's the real kicker. It's a stark reminder that understanding the mechanics of leverage is just as important as understanding the market itself.
Wow, cutting 26,000 jobs just to pivot toward AI efficiency seems like a massive move by Visa. It really puts the pressure on how quickly the industry is adapting to this new reality.
It's a classic strategic pivot. They aren't just cutting costs, they are reallocating resources to areas where they believe AI will generate the highest growth, like cross-border payments and stablecoins.
So it signals that the focus is shifting from maintaining existing structures to chasing future innovation. It makes you wonder what the other financial institutions are doing in response.
Exactly. The core challenge for finance leaders now is figuring out how to balance that automation with managing the human element during such a rapid transition. It's less about headcount and more about skill sets.
I think the real question is how they manage that transition internally. Preparing the existing teams for AI-driven changes is going to be the biggest hurdle for everyone. So Amazon and PayPal have officially rolled out buy now, pay later options in Germany and Austria starting this August. That's a pretty big move for online shopping flexibility.
It is a strategic expansion, really. This collaboration highlights how quickly BNPL is moving from a niche payment method to a mainstream expectation across the continent.
It makes you wonder how this will change consumer habits. Are you seeing this trend accelerate because of shifting consumer preferences rather than just the convenience factor?
I think it's a perfect storm of convenience and market positioning. For retailers, it shows the demand for flexible solutions, and for PayPal, it solidifies their footprint in the European fintech space.
And what about the regulatory side of things? How do you think regional regulations will shape the future evolution of BNPL across Europe?
That's the million-dollar question. Regulatory friction will likely determine the speed and shape of its evolution more than consumer preference alone.
So, MoonPay has launched something called PayBox, which is essentially a payment vault designed for AI agents to transact on the open internet.
It sounds like a significant step toward agentic commerce. Allowing AI systems to autonomously handle purchasing and financial operations without leaving the conversation is quite a leap.
That opens up some really interesting possibilities for AI-driven automation. How do you see this changing the landscape for enterprise finance right now?
It fundamentally changes the stakeholder dynamic. We are moving toward a point where AI agents aren't just tools, but active participants in the financial ecosystem.
Exactly. It makes the question really pressing. How will organizations adapt as these agents become new stakeholders in that financial structure? Citadel Securities is predicting a 25 basis point hike this week, which is certainly a big move. It sounds like they are really focused on the Fed's credibility right now.
They are framing it around inflation and labor stability, which is classic macro justification. It really boils down to whether the Fed can maintain that delicate balance between controlling prices and keeping the markets calm.
So, if they move, how do you think that translates into actual liquidity for investors? Does that suddenly change investment strategies?
It certainly changes the calculus. A surprise move could shift expectations about future policy, which directly impacts how investors price risk and adjust their investment strategies in the coming months.
That makes sense. It's all about that uncertainty, isn't it? Managing that tension between inflation control and market confidence seems to be the central theme. So, a federal judge temporarily blocked Minnesota's ban on prediction markets, meaning platforms like Kalshi can keep operating. That sounds like a big win for fintech entrepreneurs.
It certainly does. This ruling puts the focus squarely on federal oversight for event contracts, which really highlights that ongoing tension between state and federal authority in financial innovation.
It makes you wonder how this precedent will influence future state-level attempts to regulate these markets. Will states be more or less able to restrict these emerging financial spaces?
Well, it sets a precedent that federal involvement is key, suggesting that state-level restrictions will face a higher hurdle when trying to regulate these types of contracts.
I suppose it reinforces the idea that federal authority plays a larger role in defining the boundaries for these new markets. It's fascinating how quickly these legal battles shift the landscape. So Coinbase just moved Rob Witoff up to CTO. That's quite a shift for a company operating in such a volatile space.
It certainly is. Moving from head of platform to CTO signals that the focus is now heavily on the technical and strategic direction of the entire infrastructure, rather than just the platform build itself.
It makes you wonder how much weight that kind of leadership transition carries in the broader fintech world. Do you think this kind of internal shift usually drives more innovation?
It often does, but execution is the bigger hurdle. A change in leadership requires a clear strategy to ensure that the innovation doesn't get stalled by organizational friction or internal resistance.
Exactly. It really highlights that for crypto and fintech, the people leading the technical direction are crucial for setting the pace of change.
Absolutely. Leadership transitions are a microcosm of how the entire sector adapts. The success of that new CTO will depend entirely on how effectively they manage both the existing execution and future innovation.
This story about Increase acquiring a community bank is fascinating. It really highlights how fintech is moving beyond just apps and starting to integrate directly with traditional banking structures.
It certainly does. It shows that the next big growth area for these startups isn't just innovation, but securing those traditional banking licenses to offer comprehensive services.
Exactly. It makes you wonder how this convergence will reshape the entire financial services landscape for everyone. It's a big step in legitimizing the technology.
From an investment perspective, it underscores the strategic value of those regulatory partnerships. It's a smart move if the goal is true scaling rather than just niche innovation.
So, it seems the future of finance involves building bridges between the digital and the traditional. That's a really compelling picture to see unfolding. All right, we're hitting the final rapid-fire round for this episode.
Let's jump right in.
Fanatics enters prediction market with BGC acquisition.
X-Money emerges as a comprehensive financial app for premium subscribers.
Ramp expands finance platform to Canadian businesses.
Crypto Clarity Act delayed due to legislative prioritization.
Charities grapple with outage at CAF Bank.
Charity suffers reputational damage after fake collection bag incident.
Charity lawsuit over event cancellation dismissed.
Cisco releases AI model for deep networking operations.
U.S. bans imports of foreign-made robots over security concerns.
Snowflake launches AI agent governance layer.
Abnormal AI expands behavioral security platform.
Ricoh upgrades AI runtime platform with browser-based security.
Mark Zuckerberg argues for accelerated AI development.
Encore AI raises $30 million for AI agents trained on customer interactions.
Censorship in Chinese AI models may not transfer after distillation.
Major music labels call for ban on AI-generated songs.
OpenAI's GPT-5.6 Sol improves efficiency and performance.
XAI sues Minnesota over ban on AI-generated intimate images.
Spotify builds index for fast point queries on petabyte-scale data.
Pinterest replaces static user embeddings with dynamic clusters.
Atlassian migrates from Kinesis to Kafka for massive event processing.
MotherDuck's guides feature business context alongside data.
Apache Tunnel offers alternative to handwritten ingestion scripts.
73% of enterprises monitor and alert on AI agents.
CockroachDB advocates for unified data storage under serializable SQL.
Anthropic reduces system prompt length by 80% with no performance impact.
Thinking Machines Lab co-founder resigns to join OpenAI.
FCC bans imports of new Chinese robots over security concerns.
Charity Report examines AI adoption across the nonprofit sector.
That's today's show, scripted and produced with AI by Tahababa.
You can read the full write-up anytime at blog.tehababa.com. And if you want these landing in your feed most days, hit subscribe.
See you next time.